What's going on, everybody? Today we're going to get into chapter 5 and we are going to talk about budgeting. So, the first part of chapter 5, the learning objectives, we're going to start with tracing the budgeting process, discussing the relationships between goals and behaviors, looking at the importance of being conservative, and we're also going to look at timing factors in our budget. So from the bottom of the first page, we're going to look at what goes into our financial planning process. So first off, we've got to define our goals. And we've talked about that in the first couple chapters in your assignments, looking at what your goals are, both short-term and long-term, as far as financially, career-wise, and then getting into what you want to obtain and what you want to be able to purchase over these time frames, such as getting a car or obtaining a house or whatever, depending upon what stage of life you're in. So we've got to come up with expectations and realistic as far as our budget. We got to be able to gather the data, and that looks into the financial tracking and tracing that you're going to be doing over the course of this semester and working into our final project. We've got to create our budget. Then we've got to look at, compare actual results to what our plan was, and be able to make adjustments, and then go around and around the circle again. So as far as defining your goals, ideally we'd want to be looking at our current financial information. Well, some of that, we don't have right now. You're going to work on collecting that over the course of the next 4, 5, 6 weeks throughout the class here. So for right now, as far as our you're going to be working a little blind if you haven't been doing any of this tracking previously. If you have and you are good budgeters so far, then you've got data where you can use and maybe adjust your current budgets throughout some of the activities we're going to be completing. So one thing it brings up within the textbook is conservatism, being conservative. And we want to under budget income and over budget expenses. So that's how we be conservative. We want to give ourselves some cushion, some wiggle room, because things aren't going to go perfect. Things aren't going to go exactly like we hope to plan. We're going to have, different things that show up, different medical bills, different unexpected things that we're going to have to make adjustments for when they happen. So we'll create our budget, we'll come up with our plan. As we're analyzing our data, tracking that, we've got some various time periods that we can work from. And the examples they provide us here in the textbook are, of course, weekly, monthly, and annually. And, a lot of our expenses, they're going to have different frequencies, so that we need to be able to look at things. I think, weekly is probably too short. I would suggest monthly, because, most of our bills, most of our expenses, we're going to recur on a monthly basis. So that gives us a fair, analysis between what do we have coming in from our various sources of income, whatever they are, and then how does that compare to our weekly, monthly bills. And then we've got to make adjustments in there for things that are non-recurring and things that don't happen with that time frame as well. And then, we do our comparisons and see what happened. And either we got to make adjustments or we got to change our goals, depending upon how our results went. So hopefully throughout the time of creating our budget, we've talked about different goals, and we can, set in limitations, set in planning within our budget to meet those goals, set in certain savings to reach whatever goal that we have. And we may have to, if we look at some of these numbers and in our budgeting, in order to have that savings, have that planning, we got to, set limitations on ourselves, more than likely. Not go eating out as much, not spending as much going to the movies or, whatever fun activities that may be siphoning off a larger chunk of our income than is, necessary. So at the end of our time periods, we've got to compare our goals and we've got to reconcile that to the actual results, and we've got to be able to make those adjustments if necessary. Once again, be conservative and make sure you're using enough of a time period that you don't have too much data, but you also don't have too little. Like I said, for the most part, we're going to look at things monthly, but then we have to be able to factor in those items that are non-recurring. In the next part of our chapter, we're going to take a look at what goes into the comprehensive budget and those different components and do some more specific explanation on those various components, and you can see what those are in the other bullet points here. So the textbook talks about the concept of the comprehensive budget, which is made up of our operating budget and our capital budget. So for our purposes here, our operating budget are those recurring month-to-month bills, our regular things that we have, phone, TV, internet, mortgage, gas, etc., etc. So those living expenses, any loan payments that we have on a month-to-month basis, whether they be car loans, home loans, personal loans, whatever. And then factoring in any savings or any additional contributions to either investments or a retirement plan. And generally, like we talked about earlier, we want to look at a fair time period. We want to look at things on month to month, but then also on a year-long basis. So it's, it's going to take time. We're going to try and, start to build these skills within the class. Like I mentioned, through our final project, our financial tracking process, I want you to get in the habit of taking a look at your expenses, taking a look at your income. But then really, once the year is over, you'll get the full big picture of how everything carries out. And then you'll be able to set yourself up to be prepared for those going forward. Then also within our comprehensive budget, we look at our capital budget. So from a business perspective, our capital expenditures, we're looking at long-term expenditures. Major asset purchases. So they talk about your capital expenditures here, your purchase of durable items. You're looking at long-term things, houses, cars, fixing your roof, redoing your kitchen, fixing up your bathroom. It could be investing in rental property, investing in other types of businesses. Whatever those long-term major purchases are. So as part of our operating budget, it breaks things down looking at, like I said, your financial history, looking over how things go month to month. And, generally, we should get active, predictions. A lot of our recurring expenses, like I mentioned, they're going to be similar from month to month. We've also got to take into account micro factors and macro factors. Micro factors would be things that are specifically affecting you, which could be, if you're a small business owner, what's expecting your clientele, and how that's going to impact your business. Your job would be, what number of hours you're working. Some of your expenses might be factored in by, the size of your family, if you're expecting another child, things like that. Where macro factors, we're looking at the economy. Say there's a change in interest rates, that's going to have an effect on what student loan payments or mortgage payments, might be. Things like that. So you can read through those pages if you want to go back to those fun econ classes that you have made, you have had to go through previously. And you can just see a few more of those items here on the next slide. And then also the time value of money you could have it factored in that we talked about in the last chapter for some of these long-term decisions. So make sure a comprehensive budget, we're looking at, once again, our operating activities and our capital activities, factoring in recurring expenses and then the non-recurring items, the major purchases that we're saving up for. So we got to look at what our goals are in the short term, what our goals are long term, and be able to factor those into our budgeting, factor those into the saving to be able to carry out those long term items. And of course, we can bring into the specific things that affect us. We can bring into the long term planning of what's going on in the economy, what's inflation, what's happening to interest rates, things like that. So we may need to make adjustments to our budget going forward as we see those changes happening around us. And depending upon if you have any variable interest loans that could be affected by those things. This next section, we're going to talk about a cash budget. We're going to look at a little bit specialized budget, tax budgets. So once again, our cash budget, looking at those, what's coming in the door. So, that income statement chapter, we looked at, our gross wages. We looked at, having a category for the stuff that we didn't see, the taxes that are being withheld from our check. We were just factoring in interest on our debt, not necessarily the principal payments. Where if we look at things on a cash basis, that's the entire payment. So both principal and interest that are going on our debt. That's looking at what is my take-home pay from my job. And then what is being transferred to savings. Just like we talked about earlier, being able to factor in the month-to-month things, but also knowing when are seasonal things. If your property taxes are due a certain time of year, making sure you have the cash to make that payment. If you have to make a tax payment, knowing April 15th, you're going to have that money in the account to be able to make that payment. And you can be more specific and then get into a budget for taxes. And this may be more important if you are self-employed. So if you're self-employed, you have employees being able to make sure you can do your quarterly tax payments for your business and then also for yourself. If you're self-employed, you're going to have self-employment tax that you have to deal with. That's going to make up for Social Security and Medicare that would be taken out of your check if you were an employee. So you've got to be able to make those payments quarterly. If you have transactions that are going to affect you tax-wise, if you have investments and you're going to be selling them and you have to prepare for capital gains tax, you would need to be able to create a budget and be able to factor those items in so you can account for them and you can be able to pay those things off. Or make sure you hold on to enough cash to be able to pay them off at tax time. If you plan on taking an early retirement draw, that's all going to become taxable income. Sometimes they do the withholding. They may not if you don't do the paperwork correctly when you do the draw. You're going to have to be able to make that payment. And then depending upon what side activities you have, you could have a specific activity budget for, maybe a side business that you have, or a rental property business, or if you're doing investments, any day trading that you're doing. You could have separate budgets for tracking and preparing, what do you expect income and expenses, factoring in capital gains, dividends, interest, things like that. And be able to be prepared and make decisions. But all these individual activities, you also can't forget to backtrack and look at the big picture. How is this all going to come together to affect you? And then the last part of the chapter is talking about budget variances. So we're going to talk about a budget variance. We're going to talk about monitoring your budgets and being able to catch when these variances are. So very simply, variances are differences. How different is your plan, your budget, to what actually happens? So obviously on the income side, you could make more money than you were planning. Maybe you worked more hours, or you took on a second job or a side hustle or a small little business. So then you had more income than you were planning on. Well, then you got a little room and you've got some extra money that you can do something with. And you can see all the factors that could cause you to have more money. I don't necessarily need to look at that from that macroeconomic perspective in this case. Same thing on expenses. You're going to have a variance when your actual expenses then are different than what you were planning for. So whether your expenses were higher than what you were budgeting for or they were less than, you're going to have a difference. So either specific things cost you more or you use them more or less, is what caused that. You went out to eat more times than you were initially thinking. Or the price of internet went up, so that bill increased because of what they were charging, or Verizon changed what they were charging you for your cell phone, etc., etc. And we can look at the different variances. You can get specific into quantity variances. You can get into price variances. And this goes back to things that you've covered in managerial accounting. If you've taken Accounting 2 previously, once again, the textbook gets very micro and macroeconomic. That's not necessarily a large thing of importance for me. My expectations here is just that you recognize that change and what it came from. And then you're able to make adjustments afterwards. So whether you need to make use adjustments, you got to look at a cheaper internet package or a cheaper cable package or cutting the cord or whatever it is to account for changes and variances that happen for what you were planning. Cut back going out to eat. How many different times a month? And it could be it was just, a one-time thing. So part of this is making sure you're looking over things from a long enough time period. So don't just take this 4 weeks, 5 weeks, 6 weeks, this time period over the course of this class, as necessarily gospel. As we talked about in the previous chapters, we want plenty of data to be able to make our decisions. So I want you to keep doing this after this course and looking at, okay, what were your expenses in May, in June, July, August, September, October, etc. And then you can get a longer trend as far as what your expenses regularly are. And if you see those things are getting high month after month after month after month, okay, then you got to do something about it. Unless you're happy with that. It's all up to your personal preference and what are your goals that you're budgeting for. So if you want to, you can get into the specifics in what is causing those variances. And in the last part of the chapter, once again, we're talking about comparisons, looking at our financial statements to our budgeting, looking at those comparisons, being able to value, the things I was just talking about, valuing your choices and where do you want to see your money going, what are your goals, and how are you going to get there. So both through our financial statements and our budgets, we can summarize and see where we're at. Where's my money going month after month after month? And I can see what choices I'm making that are causing some of those expenses, and then being able to make changes so I can reach my goals. And, like I said earlier, we're looking at many months at a, over time. This is a continuous process. Ideally, it's continually going over the course of the rest of your life. You should always be tracking where your money is going and being able to make wise decisions and prudent financial decisions to reach wherever you want to get. And we've got all different kinds of things that can go into what's affecting those costs or that income that you have in your financial statements and your budgets. So that's chapter 5. So we've got some questions within Moodle, and then we also have a little Excel spreadsheet. I want you to go through and create a budget. So if you have a different template that you like to use, you can certainly do that. But I'd like you to keep it to the same type of format and show me, what's coming in and projections of what's going out. And, if you've done financial planning previously, you've got the data to do that. If you don't, it's okay. Just make projections of where do you think your money is going from month to month. And then once we do the tracking exercise, we'll get that comparison later, and you can make, better decisions once we get towards the end of the class, more accurate decisions. So if you have any questions on any of those, please don't hesitate to shoot me an email. Thank you.